Okay, there we go. I can see that the numbers are starting to creep up. So welcome everyone. We will just give it a couple of minutes before we kick off, just to give people a moment to join. And I guess while we're waiting, just to say a couple of things. Really do like to keep these as interactive as possible. So please do say hello to each other. There we go. Hi, Ruby. But please do, you can pop messages into the chat. Introduce yourselves, tell us a bit about where you're from. And throughout the presentation, you will see polls popping up. We do ask you to and encourage you to participate in the polls. All you'll have to do is click an option or an answer. And then if you do have any questions as we're going through, I generally say to people just to try and put them into the chat, because sometimes by the time you get to the end, when we're going to do Q&A, you might have forgotten your question. And sometimes your question might actually be answered by the time we get to Q&A. So it's just a great way to keep on top of that. We had great registration for this webinar. I think several hundred women have registered. So just going to give it a few more minutes while everybody joins. I can actually get the slides ready in the meantime, get them up on the screen. So we're good to go. There we go. Right, we'll just give it 1 more minute and then we will kick off. Okay, so I think we can get started. Right, so welcome everybody and thank you for joining us this evening. We are going to have a interactive session and it's all going to be about pensions and ISAs and pensions versus ISAs. I won't say much more than that because I won't give it away. But over the next sort of 60 minutes or so, the aim for us is to really leave you with actionable and tangible tips and things and steps that you can take away. I am a massive fan of webinars and events, but one of the things that typically frustrates me is that when I go to some of them, I find the content fantastic, but it's not often clear what I'm supposed to do next. Or sometimes, life just gets busy. And so even though you're sort of well-intentioned in terms of what you want to do next, it often doesn't happen. So that's not what we want here tonight. So we want each of you to leave with at least 2 things that you're sort of committed to going away and doing after this webinar. So, right, let's get into it. In terms of the agenda, we're going to start off with some introductions. We're then going to start talking about pensions, getting a sort of base level understanding of what pensions are and how they work. We'll then do the same thing with ISAs. And then we'll jump into looking at the 2 of them sort of side by side. Which is better, a pension or an ISA? If you have some money, which of the 2 should you put it in? Would you put it in? Why? We'll then look at how best to prepare for retirement before following up with, as I mentioned earlier, some crucial next steps and also Q&A. So if you do have any questions at all as we're going through, please do pop them into either the chat or the Q&A section, just so that you remember them, because we will come to them towards the end. So let's get into it. So what is Propelle? So as many of you will know, and some of you won't, those who are new, Propelle is a female-focused investment platform designed to help women invest more confidently, invest with confidence, and build long-term wealth. And we structure Propelle through 3 pillars: learn, where we have a whole range of different courses, blogs, videos, and webinars, all in platform that really break down investing into digestible pieces for you to go through and to beef up your knowledge and confidence. The second pillar is connect. We run events where women can get together, you know, over some nibbles and a few bubbles to talk about investing, talk about what you're doing, but more importantly, just meet other women who are, you know, interested in building wealth too. And then finally, the investment part. We have an investment platform where you can go and get access to certain types of investments. And we will soon be launching our own ISAs. So maybe you might have some inclination as to which part of this presentation I'm going to be talking about. So who am I? I am Aisha Ofori, the founder and CEO of Propelle. I have a background in wealth management. I was a wealth manager at Goldman Sachs for a number of years before leaving to start my own business, to start Propelle. There are a few accolades and things on the screen there, but I won't jump into that. What I want to do now is hand over to my fantastic guests so that they can introduce themselves.
Hi, I'm Becky O'Connor from PensionBee. You can't see my intro slide at the moment, but I am the Director of Public Affairs for PensionBee. I am still a journalist. I write a column for the Daily Telegraph, which is called Pensions Doctor, and also a comment column for the iPaper. I used to write about personal finance for the Times newspaper. I've written a book called the ESG Investing Handbook, which is all about sustainable investment, so a little bit off the pensions theme there. And I used to work for Royal London, which is a large mutual insurance company and pension provider, and Interactive Investor, which is an investment platform that offers self-invested personal pensions. So I've dealt with pensions of all kinds in my career, and I also co-founded a website called Good with Money, which is about ethical personal finance.
Fantastic. Thank you, Becky. And over to you, Alice.
Hi, everyone. It's great to be here. I'm sorry about the slightly yellow hue. I've actually just moved house, so the light is not quite right, but thank you for bearing with me on that. So I run the financial education platform called Go Fund Yourself, which is really about better conversations about work and money. I also write for Glamour magazine, The Times from time to time, and the Daily Telegraph. I also do various bits of kind of campaigning work. I led a campaign around Buy Now, Pay Later, calling for regulation. And my academic background is as a behavioral economist, so looking at how we can make better decisions about our financial lives, and also how the likes of banks, pension providers can help us make better financial decisions as well. So it's great to be here, and I will be hopefully shedding some light on the differences between ISAs and pensions, and also how you can kind of optimize across both of those different financial products.
Fantastic, thank you. So as you can see, we've got quite a range of experience across the panel today, so please don't be shy with your questions and pop them into the chat or the Q&A section. So before we get into that, quick poll, because as I said at the beginning, there will be polls throughout this. So let's test it and get you guys interacting. So what have you started doing? So let me launch poll number 1. There we go. Have you opened an ISA already? Do you have a pension? Do you have both? Do you have neither, but you're curious to learn? No right or wrong answer here, really just getting a sense of what you guys have already started. Okay, and I will share the results at the end of the poll so that you can have a look as well. Quite interesting. Just give it a couple more seconds for a few more people to join. There are a few who haven't clicked yet. I will stop it in a couple of seconds, but remember to stay nearby because there will be more polls throughout. Okay, I'm going to end it there and share the results. So most people, 72% of people have both, or 72% of those who answered have both, which is fantastic. 20% of people have a pension and 6% have just an ISA. I think the positive thing there is that a lot of you already have both. So I guess you have ideas already as to, you know, which you prefer and why, but we'll jump into more detail about both of those as we go through the presentation. Okay, so now let's jump into the section on pensions. We're going to look at what is a pension and how does it work. So I'll hand over to Becky.
Thank you very much, Aisha. So what is a pension? It's a fair enough question. It sounds very basic, but actually it's worth going over the basics, I think. So a pension is a place to invest, and that's a crucial word when it comes to pensions because they are investments rather than savings. And they're a place to invest while you're working. And that's also crucial to a pension because the idea of a pension is that you contribute to it out of your earnings through work. It doesn't have to be through work. You can add to your pension any extras that you want in addition to contributions through your work, but primarily pension contributions happen through work. And they're designed to support you in later life. Now, this is also really important because a pension is something that you can't actually access until you're in later life. So unlike ISAs or savings accounts that can be accessed sooner, a pension is specifically for retirement. You might have received a pension from your current employer or previous employers, and you can also set one up for yourself. So through auto-enrollment, which was established in 2012 and is the kind of newish pension system where you get a pension automatically through work, you probably do have one, unless you haven't been employed traditionally through an employer lately. If you're self-employed, which we'll come on to, it's slightly different. But even before auto-enrollment was a thing, you would probably have been offered a workplace scheme. Even if you weren't auto-enrolled into it, you probably would have been offered the chance to enroll yourself into it. If you are self-employed or if you are, unemployed for a period, you can set a pension up for yourself as well. It doesn't have to just be through work. There are different types of pensions. So when we talk about pensions, we have different things in our minds. There is the state pension, which is to do with work in a sense that you get qualifying years for the state pension. You have to work in order to get a state pension of some degree, and how much you get depends on how much you work. Then you have the workplace pension, which you are now auto-enrolled into, and that is something that your employer will offer. And then you have the option of personal pensions too, which enable you to consolidate old workplace schemes into one place. And if you're self-employed, allows you to have a pension of your own, regardless of not having an employer. Then there's two other complications to the pension thing, which is that you in a workplace scheme, you are actually more likely to have what's known as a defined contribution scheme, which is one where you pay in a certain amount, your employer pays in a certain amount, and then what you get at the end depends on what you've contributed and also investment growth over that period. Defined benefit is something that you can still get if you're employed in the private sector, but it's increasingly rare. It's usually a public sector pension offering, and it's usually based on what you earned during that time. So defined benefit is usually career average earnings based now, which is based upon what you earned during your time working for that employer. Teachers have defined benefit schemes, so do nurses, other people employed in the public sector, but also there are still a few large employers in the private sector that offer defined benefit schemes. The chances are, if you were working several years ago, before mid 2000, I don't know, 2005-ish, you would have had some sort of defined benefit scheme on offer. Since then, the probability is that you've got defined contribution. That's the norm now, but if you're not sure, it's worth checking. So how good are pensions for retirement? Pensions are for retirement. That's their whole purpose. So they should be really, really good for retirement. The state pension is a regular payment that you get from the government once you reach state pension age, which is currently 66. It's rising to age 67 from 2028. It may rise further. That's an unknown, but it's something we speculate on all the time because the whole state pension system is quite difficult for the government to sustain as the population ages and so on. So the state pension at the moment pays around £10,600 a year, and that's the full new state pension. That's for those who have 35 qualifying years. It's going to rise again by 8.5% this year for those receiving it, which will take it to about 11,500 a year. Now, that's actually a huge proportion of most people's retirement income when they get to retirement. It's the majority of retirement income for a lot of people. So the importance of the state pension to what you have when you retire can't be underestimated. And to achieve the same amount of income through a private pension would cost you an awful lot of money. It's not set in stone, but probably around £300,000 at least. So they are very valuable, and it's worth building up those contributions through working life and also checking on what you've already built up. Workplace pensions. So these are also incredibly valuable. And one of the reasons they're so valuable is that employers pay in as well as you. So your employer is going to pay in at least 3% of your qualifying earnings. You pay in 5%. That 5% you pay in includes tax relief. If you're a basic rate taxpayer, that tax relief is 20% of your contribution. So you pay in £80, the government pays in another £20 to take that contribution up to £100. Tax relief basically means if you took that money now into your bank account, you would pay tax on it, but if you put it in a pension, you don't. That's what the phrase tax relief means. It is effectively free money from the government. You can't get anything like that kind of uplift from a savings account. It's very difficult to get that kind of uplift through investment growth alone as well, if you just invest in the stock market without doing so in a pensions wrapper. So it is hugely valuable. If you're a higher or an additional rate taxpayer, you get even more tax relief because obviously you pay more tax. So if you put that money in a pension, instead of taking it now, you get 40% or 45% if you're a higher or additional rate taxpayer. So you could say it's even more valuable if you're in that tax bracket. With a personal pension, you still get the tax relief. It works slightly differently. If you're a higher or additional rate taxpayer, you probably will have to claim that additional amount back. You will get the 20% basic rate relief added automatically. What you don't get if you're self-employed, of course, is the employer contribution of 3% or often more, actually. Some employer schemes double match your contributions up to a certain amount and can go as high as 25% for the total contribution. If you are in that kind of scheme and you don't know it, then you could be missing out massively. So my takeaway from this in particular is that you should definitely check what your employer contributions are in your workplace pension. So to qualify for the state pension, you're going to need 35 qualifying years of national insurance contributions. It sounds like a lot, but actually, if you think of a working life from when you leave university or college to when you're 66, you're probably going to be all right. And actually, you may have some qualifying years that you don't even know about from when you're at university, if you had a job on the side, for instance. The age to claim a state pension is rising. It's 66. If you know you're slightly younger than me, in fact, my age, it's going to be 67, possibly older than that still. There has been talk of it rising to 70. I don't want to scare you because that's not official, but it really depends on how the government manages the sustainability of the cost of the state pension. I think it's fair to assume you're going to get some. I don't know how much. At the moment, it seems quite generous. It can be really hard to live off the state pension alone. So it's £10,600 for the full new state pension at the moment. it doesn't really cover living costs. There's something else called pension credit, which is available to people who don't have enough once they reach state pension age to meet their living costs, if what they have coming in is substantially lower than the state pension. So you do hear of people managing to live off the state pension very well, but it really can't be guaranteed that you'll manage your costs, particularly if your costs are higher than average when you reach retirement. With personal and workplace pensions, it's important to know that when you reach retirement, you can get 25% of your total pot tax-free. That's an amazing benefit of pensions. But after that, you will pay tax on income that you take from your workplace pension. Usually it's basic rate tax, but we'll come on to that and how it differs with ISAs soon. There are also limits to how much tax relief you can get on your contributions that you make to your pension. There is the £60,000 annual limit, or up to your maximum earnings in a year. And the earliest you can access your pension is age 55. So paying into a pension, hoping that you might get the money sooner, is not going to happen unless there are specific medical terminal illness reasons, for instance, why you would need to access that money sooner. The minimum age to access your pension is rising from 55 to 57 in 2028. It's designed to rise in line with when you're entitled to the state pension. So again, if the state pension entitlement age rises, so will most likely the age at which you can access your private pension too. Okay, so on the basis of everything that you just heard, what is the state pension? Answers in the poll.
I'll give you guys a few more seconds. Okay, I think it's pretty safe to say that everybody's been listening, which is fantastic. So what is a state pension? It's a regular payment from the government that most people can get access to. I have seen that we've had loads of questions coming in already around pensions, which is absolutely fantastic. We will get to them, don't worry. There was also a question coming in asking about whether or not there's going to be a recording of this. There is a recording that will be available, and I'll explain at the end about how you get access to that. So wonderful. Thank you very much for that, Becky. We are now going to be moving on to the next topic. So if this was sort of like a boxing match and you have pensions, on one side of the ring, we've got ISAs in the corner. And I'm going to start taking you through that now. So what is an ISA? An ISA is, or it stands for Individual Savings Account. I personally think that's a bit misleading because the way that I kind of look at it is there are different types of ISAs, and some are better for saving and some are actually better for investing. So by just lumping them all under the umbrella of savings account, I think it's a little misleading because, as I said, some are for investing. But anyway, that's what they stand for. I didn't make the name. And there are 5 different types of ISA that are available to UK residents, and they all have slightly different rules and different benefits. So let's just have a look at the 5 different types now, and then we're going to do a little bit of a deep dive into some of them. So there is the cash ISA, which is pretty much what, does what it says on the tin. This is where you can invest your cash. It's quite similar to investing in your cash, saving your cash in a current account, and you look to get a return. But as with all ISAs, there are tax benefits that you get, and we'll come on to that in a second. The next ISA is a stocks and shares ISA. This is where you can invest in stocks and shares, so where you can invest into companies and buy, for example, shares in companies, or you could invest in funds. A fund is where you have you invest, but you have lots of underlying companies in there. So you get, I guess, more choice because you're not investing just in cash in stocks and shares ISA. A lifetime ISA is a special type of ISA, which is typically for two things. Either for those people who want to become, who are first-time buyers and want to purchase a house, or you can use your lifetime ISA towards retirement. But again, there are restrictions. We'll come on to that in a second. And then there is an innovative finance ISA. And this one tends to be the one that people have heard about the least. It's typically for people who want to invest in alternatives, but specifically for peer-to-peer lending. So it's where you can effectively lend your money to an organization or to a particular or through a particular type of investment vehicle. And then finally, we have the junior ISA, known as the JISA, and this is for children. So let's have a look at those in a bit more detail. So first things first, with the first four ISAs that are for those of us who are over 18, there is an annual limit of £20,000 per year. And for the junior ISA, the annual limit is currently £9,000 a year. So let's just take a look at how that could work. You could, for example, invest your whole £20,000 limit into one of the ISAs. In scenario one, it's a cash ISA. You could put all 20,000 into a stocks and shares ISA, or if you wanted to. Lifetime ISA is different because that does have a lower cap. The cap for the lifetime ISA is £4,000. So if you have a look at scenario two, in this example, the total across all the ISAs is still £20,000. You're still getting your ISA limit, but you're also falling nicely within the limit that's specific to the lifetime ISA, which is just £4,000. So what are some of the benefits of these different types of ISAs? So first of all, what can you invest in? So I've covered this already. Just to recap, cash ISAs, put cash in. Stocks and shares ISAs, this is where you can invest in funds. An example is an ETF, an exchange traded fund, or you can invest in stocks, which is where you actually get shares in the individual companies. A lifetime ISA, you can have a mixture. You can have some cash, you can have ETFs, and you can have stocks. And then, as I mentioned earlier, for the innovative finance ISAs, it's for peer-to-peer lending. Now, the main benefit of all of these is that there's some kind of tax benefit. So for cash, you can save tax-free, so you won't pay any tax on any of the profits that you make or the money you put in. Exactly the same for the stocks and shares ISA, you invest tax-free. With the lifetime ISA, it's a little bit more tricky. You get a top up. So similarly with pensions, you do get a top up. So for every £4 that you put in, the government will put in £1. So you get that 25% top up. But there are some considerations around the lifetime ISA. For example, you can't invest in them if you're over 40. Typically they're or you've got to be between 18 and 40 years old to start. As I said already, it's got the £4,000 limit. And there are a few other things as well in terms of like when you can actually take the money as well. Typically, it's after you're 60 years old, you can take the money without any penalties. If you want to take it before that, then there is a 25% fee, for example. With the innovative finance ISAs, again, everything that you invest in them would be tax-free. In terms of the rules, the one that has most rules is the lifetime ISA, as I said, and I've mentioned some of them before. It can go into sort of more detail. For example, if you're going to use your lifetime ISA to actually purchase a house, then there are restrictions on the value of the house, for example. It has to cost less than £450,000. You have to be a first-time buyer. The lifetime ISA must be open for at least 12 months before you purchase, before you use it towards the house. You have to buy the house using a solicitor or conveyancer, which most people do, so that's fine. But there are just a few more rules around using the lifetime ISA. And as I mentioned before, the restricted drawdown. So there's a time frame as to when you can actually access that cash. But the benefit for all of them is that you get those tax breaks. So I think just by this description here, if you were going to sort of think about which one I say is probably most comparable to a pension, my personal opinion would probably be it's the lifetime ISA. But they all have different pros and cons, as you can see. So how good are ISAs for retirement? Well, as I mentioned, the one that I think is probably closest to a pension is the lifetime ISA. So what you can do with a lifetime ISA is you can put in up to £4,000 every year. You get that additional 25% top up, just like you do with a pension. So in this case, HMRC can add up to £1,000 every year. You don't have to use your lifetime ISA to go towards your first home. If you don't use that money, you can save it up for retirement and access it at 60. As we've said, you don't pay any tax on withdrawals. Now, with the other ISAs, you have more flexibility. There aren't any rules around when you can or cannot get access to the money. So with a cash ISA, a stocks and shares ISA, and an innovative finance ISA, you can take the money at any point that you like. Now, for most people, that sounds like a great thing, but actually, for some people, that could potentially be seen as a con, as in not a good thing, in a sense that with money that you're kind of investing for the long term, when you don't have access to it, it actually helps you to leave it there for the future because you can't actually take it out. Whereas with these other ISAs, yes, you may say, right, I'm going to have one and I'm going to invest towards the future, but you can actually take it out. So you've got to have that sort of, I guess, strong sort of self-resilience in terms of not actually taking that money out if you are using it for the future. What else have we got on here? Yeah, I've mentioned these things already in terms of the age for the ISA being 60 years old, the £4,000 limit, and then the fact that you can take the money out of the other ISAs whenever you want, which may not be a good thing if you are saving for the long term, because you might be tempted to dip into it. Okay, so it is poll time again. What is the maximum you can put into a lifetime ISA per year? I'll actually be a little bit disappointed if people got this wrong, because I think I said it about 5 or 6 times. But let me launch the poll and let's see how engaged everybody is. And remember, this is for the lifetime ISA, not the other forms of ISAs. Okay, so I'm going to end the poll and share the results. So maybe I haven't been as clear as I could have been. So for the lifetime ISA, the limit is £4,000 a year. For all other types of ISA, it's £20,000. So majority of people got that right. So just to make that clear again, the limit for the lifetime ISA is 4,000, and the limit for all other types of ISA is 20,000. And don't forget, any questions on anything that I've said about ISAs, please pop them into the chat. We will come to your questions towards the end. Right, moving on. This is where we compare the two more closely. So I guess this is probably the round or one of the rounds that will determine the winner, who wins pension versus ISAs. So I'm going to hand over to Alice and she will take it from there.
Great. Thank you, Isha. So yeah, on with the head-to-head. I think it's worth also just pointing out that ideally, which we'll talk about how, ideally you optimize all of them and you make the most of your pensions and your ISA. But obviously at the moment, times are difficult, and I appreciate that you may find yourself trying to choose between them and so on. But let's have a look at how they compare across various factors. So personal allowance, this is basically how much you can actually save or invest into a pension and an ISA. Pensions first. Typically, you can contribute up to £60,000 per year unless you're lucky enough to be a very high earner. And then something called the tapered annual allowance might kick in. I won't go into loads of detail on that. It applies when you're earning above £200,000, or your adjusted net income, as it's often called, is over £260,000. If that does apply to you, then I'd recommend either getting financial advice or going on gov.uk for more information. With an ISA, as we've already covered, personal allowance is £20,000 per year. What I don't think we've said is that if you have a lifetime ISA, for example, you are able to have other types of ISAs as well. So you could, for example, have £4,000 in a lifetime ISA and then use the £16,000 in a stocks and shares ISA, for example, or a cash ISA. The only two that weren't historically kind of compatible was a lifetime ISA and a help to buy ISA, which is you can no longer open, but you may still have one. So worth just pointing that out. And so when I say that, I don't mean that if you have one that is currently open, you can't now open a lifetime ISA, but you couldn't use them, say, to buy a house at the same time. What are the tax benefits of actually paying into your pension or contributing to your pension versus an ISA? So as we've talked about, the main winning factor of a pension is tax relief, which is basically money that otherwise you would have paid in tax, you actually get back in the form of a 25% top up. Again, extra advantages if you are a higher rate, or you're a higher earner and therefore a higher rate taxpayer, because you'll get additional tax relief, but you will most likely need to do that through a self-assessment. So again, if you feel comfortable doing that yourself, then that's something you can do, or speaking to an accountant is probably the best way to go about doing that. With an ISA, tax benefits in no kind of tax relief that you get when you actually pay into your ISA. It's really just sheltering anything that you pay into your ISA from tax down the line, apart from obviously the lifetime ISA that we've already talked about, where you get that 25% top up. So therefore it's kind of most similar to a pension in that sense. I'm a huge advocate for a lifetime ISA as someone that's self-employed. Given that if you are self-employed, you're not getting the contributions from an employer, I sort of like to see it as those are like a mini employer contribution, but from the government instead. So I really recommend a lifetime ISA, or thinking about opening one if you are self-employed, because it's a really nice way of getting an additional kind of contribution effectively. And also you could use it towards a home. There's also talk at the moment of lifetime ISAs potentially sort of changing, and it might be the case, for example, that the minimum threshold, the maximum amount that you can use it, the value of a home that you can use on might increase, because obviously it's not necessarily a realistic amount, particularly if you live in a city like London. Most properties are over 450,000, 500,000. Tax benefit out. So this is what happens when you actually come to use your savings or investments. So with a pension, you can take 25% or up to 25% completely tax-free. This is typically at the age of 55, but it depends on your employer's pension scheme. With an ISA, 100% tax-free. So when you come to withdraw that, there is no tax that you'll pay on those savings or withdrawals. Investments. So where is your money actually going? Pensions, I think one of the things that we often kind of forget is that it is an investment. If you have a pension, you are an investor, and they are invested in pension funds. These funds, and hopefully if they are well invested, will consider the age at which you've started investing in your pension. And the idea is that if you're very young, for example, they may take more risk, and as you get older, your investments will become slightly less risky, to kind of mitigate the risk of any loss. That's essentially the idea of someone that's a good pension fund manager, and that's certainly the idea. In an ISA, there are different kinds of investments, and also it could be in cash. So if you have a cash ISA, it is just being looked after by the bank. When interest rates were low, this wasn't particularly interesting, but obviously interest rates are a bit higher now, so you can actually get some reasonable returns. If you've invested in a stocks and shares ISA, then that might be in something like a robo-advisor platform, where they are kind of picking the funds for you, and kind of doing all of the picking of investments and the making those decisions on your behalf. But you could also open a stocks and shares ISA where you're picking the specific investments yourself. That still falls under the umbrella of a stocks and shares ISA, but it just depends which kind of platform you go for, if that makes sense. We can talk about that in more detail if anyone has any questions. And then alternatives. This is what we mentioned, probably the kind of least common form of ISA, where you're investing in peer-to-peer investments and things like that, which is a much more sort of specialized and also potentially riskier type of investment. Access. So pensions, we've already spoken about. You can access your pension from 55 years old, typically. And ISAs, there is no kind of age limit on when you can access your ISA, aside from the lifetime ISA. Also, just to point out, you won't be able to open a lifetime ISA after the age of 39. So it's only from 18 to 39 you can actually open a lifetime ISA. Next slide, please. Great. So next, we're going to be looking at how you can best prepare for retirement. So thinking about all of these different assets and different types of investment and savings, how do they all work together? As I said, ideally, you have all of these things, unlimited funds, and you can optimize your retirement that way. But I appreciate that we might not have completely unlimited funds, and we need to make decisions about where we actually put our money. So there are 5 kind of places, I guess, that we're looking at. We've covered the state pension and ISAs and workplace pensions, but there are a couple of others as well, like property, that we'll just touch on briefly, but not go into loads of detail. So I guess let's think of this as how to optimize across all of them. And if I was trying to make the most of all of these different financial products together, how do they best kind of work? Actually, if we can go back a slide a second, and if I've missed any key points, I think we've probably covered most of these. I think we probably covered most of these points. So yeah, actually, sorry, if we can skip to the next one. So yes, how can they best work together? So state pension, I would firstly max out your contributions as much as possible. And by contributions, we mean national insurance contributions. You need 35 years. It's important to note that your national insurance record is not just based on the years that you've been working. It's also, you get you build up your national insurance record when you're unable to work. For example, when you're claiming employment and support allowances, job seekers allowance, or now formerly that now universal credit, and so on. You can also make voluntary contributions. So if you're panicking that you have not made enough contributions over the years, don't panic. Look up voluntary national insurance contributions, and you can kind of top up that way. There is a limit on kind of how far back you can go. It's normally about 6 years. So it's worth doing if you've not been making the most of your national insurance contributions over the last few years. And the deadline for doing that is April each year, end of the tax year. Great. So workplace and personal pensions. I think we often kind of bucket them together, but actually they are kind of pretty separate. Personal pensions you may have in addition to your employer's pension, and ideally you'd have, as I said, lots of funds and the ability to have your workplace pension that your employer is contributing into, and also a personal pension. But obviously that's not necessarily the case for everyone. So assuming you have a workplace pension, I would make sure that you are making the very most of that. As Becky said previously, finding out how much your employer actually contributes into your pension, particularly if they have something like a matching scheme where they match up to a certain percentage. It's just a no-brainer to really, really make the most of that if you possibly can. If you're self-employed, then obviously you can think about a personal pension. You might also have heard of something called a SIP, which is a type of personal pension. And that's really if you're wanting to make kind of more of your own investment choices in your personal pension and deciding kind of what you invest in and so on. So assuming you have optimized your national insurance contributions, making the most of your workplace pension, maybe even have a personal pension, what would you do with your ISA? So ideally, you would max out your ISA every year. You would set aside £20,000 before the end of the tax year, and max out, say, either into a stocks and shares ISA, a cash ISA. You could have a lifetime ISA in there as well, obviously just the £4,000. And at this point, you would need to kind of think about whether you're wanting to invest in that ISA, so take the kind of stocks and shares ISA or LISA route, or whether you want to keep it in cash. And really that's a decision that you might want to get advice on, or really think about when you might be needing to access those funds. Really, you don't want to be thinking about investing, so the stocks and shares ISA/LISA option, unless you've got kind of 3 to 5 years at least to be able to kind of ride out bumps in the market, basically. If you don't have that long, then maybe a cash ISA might be, say you're wanting to buy a property in the next couple of years, then maybe a cash ISA is your best bet. So you have maxed out your national insurance contributions, making the most of workplace pensions, maxing out your ISA. You're very fortunate if this is you, and you also own a property. So what some people might consider, again, if you're self-employed maybe and you're not benefiting from a workplace pension, you might decide that actually you're going to hopefully pay off your mortgage and one day be able to downsize so that you can take some of that money and fund your retirement that way. So that is definitely an option. And it's worth saying that if it's your only home, then you're not going to pay tax on it when you come to sell it. That isn't the case, obviously, if you're a second homeowner and that becomes and you're selling your second property, that becomes slightly more complicated. Then you've got other assets, so building a business, for example, and other income streams in order to fund your retirement. So maybe you do have multiple properties that you rent out and you're a landlord, for example, and that's certainly something that you can think about. But where most people kind of build security for their retirement is in personal pensions, workplace pensions, ISAs, and combined, I guess, an additional source of support being the state pension, but by no means relying on it. So I think we have a poll potentially, or a question, which is, what's been your biggest takeaway today? And please do pop any questions in the chat while you're answering that one.
We're mixing it up a little bit here. So rather than a poll, we just want you to pop your answers into the chat. So what has been your biggest takeaway today? Has there been anything that you either didn't know that you learned for the first time, or something that you just sort of had reinforced for you, which was helpful? Just let us know. What is your biggest takeaway? Mine personally is I don't have investments across all the ISAs, and it was just interesting to hear some of what Alice and Becky were saying about pensions, but also the different types of ISAs as well. So personally, I'm thinking, oh, maybe I should be doing more than just having one. Okay, let's have a look at some of the things that people have written. So Joanna has said that she has learned more about the different ISAs and she found that helpful. Stacey has said that there are many options to get ready for retirement and that you get to mix and match. Other people are commenting that there are age limits on ISAs that they didn't necessarily know. Rashina said that this has made her want to look at her wage slip and feel confident and that she can understand what the pension contributions mean. Actually, that's something that I really encourage people to do, but particularly also digging out your pension documents, going to find them, having a look at them, having a look at, which sort of option you're in. Sometimes people don't actually know that if you've got a company or a workplace pension, they tend to put you in the default. There are other options. And sometimes people don't know even how much they can expect to get from their pensions. It will tell you on the paperwork how much it's expecting for your pension to be when you get to retirement. And for a lot of people, it can be a shock. So please do have a look. Joyce has said that she wasn't familiar with an innovative finance ISA. A lot of people are. Most people haven't heard of that one, to be honest. As mentioned, it is typically for alternative investments, specifically peer-to-peer lending, which isn't everyone's cup of tea, but it's definitely worth looking at just to keep your options open. Right, just conscious of time, what we're going to do now is we are going to jump into the Q&A. So if you haven't already posted your question into the Q&A section, please do so now. I'm going to start calling some of them out. And Alice and Becky, I will sort of direct them to you as we go through. And we will do this for the next sort of few minutes or so. There are some additional slides after the Q&A, so please don't jump off sort of thinking this is the end. We do have a little bit more for you. Remember at the beginning I said that we wanted to make it tangible and give you some things to take away, so that is coming after the Q&A. Right, let's get into it. So question: if you don't have 35 years qualifying, does this mean you will not receive any state pension? Becky, do you want to take that one?
Yeah, sorry if I didn't mention that earlier, but if you have 10 qualifying years, you will get some state pension, the minimum amount of state pension. And then between 10 and 35 qualifying years, the amount of state pension that you get goes up, depending on how much you've got. And 35 years is the number of qualifying years that you need for the maximum amount of state pension.
Fantastic, thank you. Question here. I think this was answered, but we'll go through it again just to make sure that we've really got the messaging clear for you guys. What is best, an ISA or a SIP, or are they the same thing? I'll give that one to Alice because I do remember you touching upon this.
Was that an ISA or a SIP, did you say?
Yes.
Yeah. So I think I would suggest from a so basically you're asking there effectively pension versus ISA. A SIP is still, it's a self-invested personal pension. So it operates in the same way. Obviously, you're not getting employer contributions. So it operates in the same way as a personal pension. So you're not getting the tax relief that you would on an ISA. So I would suggest if you haven't made the most of your ISA, then you want to make the most of that first and then consider a self-invested personal pension. It also depends, I guess the caveat there is unless you're wanting to use a cash ISA, unless you're not wanting to invest, then you would want to look at a cash ISA instead. And obviously the benefit there is that you're getting hopefully an interest rate on your savings. It's not an investment, if that makes sense. But as with all of these things, it depends on your personal circumstances. And if you are in a position to max out your ISA and also think about a SIP, then I would probably suggest that you get some financial advice.
Fantastic, thank you. And just to let people know, we are going through all of the questions here in order. We will keep a few minutes at the end, as I said, for those for the following slides where we're going to be giving you some action points. If we don't get to your question, there is a QR code in the bottom right of the screen that will take you to the Propelle community chat, where we always post the questions we don't answer and answer the questions. So if we don't get to your question live, we will post the answer in there. Next question. The Help to Buy ISA has not been included here. Does that mean it's not limited by the £20,000 annual threshold? I mean, I guess the reason we didn't mention it is that it's no longer available. But Alice, do you want to take that one?
Yeah, so the Help to Buy ISA is no longer available. Obviously, that doesn't mean that you don't have one. You may still have one. It just means that you won't be able to use both a lifetime ISA and a Help to Buy ISA at the same time in order to buy a property. And a Help to Buy ISA obviously does not operate in the same way as a lifetime ISA, in that it can't be used to fund your retirement. So yeah, hopefully that answers your question. That's why we haven't covered it today, because you're not in a position to be able to open one anymore.
Fantastic. And this next question for Becky. What is the advantage of combining a pension into one pot?
Well, the main advantage is that you reduce the risk of losing track of any of your old pensions, which, given the number of jobs that people tend to have now, is a likelihood, particularly smaller pots that you may have forgotten about. You may not even have really realised that you were building up with employers that you were with for a short time. So it's that ability to have complete visibility over your pensions or pension all in one place, and also a bit more control over what they're invested in potentially as well. If you bring it all into one place, you can then invest in a chosen plan rather than having several pensions in several different plans. They're depending on the fees that you're paying on your old pensions versus the place that you want to bring your pensions to. There can be potentially a lower fee to be paid through bringing all to a lower fee pension. And also, if with the existing pensions that you have, you don't have a pension that matches your values, a sustainably invested pension fund, for instance, and you're aware of a pension where you could have that option, then you might want to move your pensions for that reason too, because not all pension providers offer sustainable plans currently. And with workplace schemes, you're usually invested in the default scheme, which may or may not be sustainable. So if that's important to you, that can also be a reason to bring your old pensions into one place, into a sustainable pension. So there's a few different reasons that may be more of a priority for you as an individual or not, but really the main reason is to avoid losing old pensions and to have control and visibility of them all in one place, which is quite hard, especially if you've had lots of old jobs with lots of old pensions behind you.
Fantastic, thank you. And actually what I've noticed here is some of the questions have been answered. So Becky has been amazing and gone in and actually answered some of your questions for you already. So if we haven't come to your question live, it may already have an answer. So if you click on the middle tab, you can see the questions that have already been answered. For anyone else who hasn't had their question answered, we're going to take one more now. A very quick one, I hope. And then we're going...
Aisha, can we do Rasheen's?
Yep.
Because I think that's a really valuable one.
Yeah, sure. Go for it, Alice.
Sorry to interrupt. Just because
No, that's okay.
One thing that which Rasheen's is, sorry, if you're married / in a partnership and pool your money together, are you able to separate your money into two separate ISAs? Basically, can you both open an ISA? And the answer to that is yes, you can. And also, this is a great question because it's a brilliant opportunity for tax efficiency, because if you are married or in a civil partnership, you can gift money to your spouse tax-free, and then that person can then invest it in their pension. And the reason not in their pension, in their ISA. The reason that I love this question is particularly when we're talking about women and caregivers in particular, and if you're taking time out of work. Often that is at the cost of your retirement savings. And one way that a partner can kind of support you is potentially through something like that. So giving you money to then put into your ISA. So yeah, I just wanted to say that because I thought that was a really, really valuable question. And if you are not married, then unfortunately, no, it is not quite as tax efficient. Unfortunately, that's one of the quirks of law in this country, is that, yeah, you do not benefit to the same degree if you're not married.
Fantastic, thank you. And just to reiterate, anyone, if your question wasn't either answered live or Becky didn't type the answer in, we will put the answers to the rest of the questions on the Propelle platform. So we are going to wrap up in the next couple of minutes, but we wanted to give you some things to take away, as said at the beginning. So here is the first thing. I'll hand over to Becky to go through this slide.
Okay, so it is January. Hopefully we've all still got a little bit of energy left for resolutions and feeling like we want to do the right thing with our finances. So here are a few things to choose from. You can consolidate your pensions in one pot with PensionBee. We offer a range of different plans. They vary depending on your risk profile. There is a default option if you're not sure what your risk profile is or what your risk preferences are. There's a fossil fuel free plan, a positive impact plan, and a Sharia plan available, so that you can pick a plan that suits you personally. We are an online provider, but we also offer the ability to pick up the phone and speak to a human being. They're called beekeepers, and they can help you directly, and they're very efficient and very good at picking up the phone, because we do think that is very important for people when they're dealing with their retirement finances and trying to get them sorted. We don't need anything to be more complicated than it has to be. And yeah, it's one thing that you can do for your long-term finances, and then you don't have to think about it again for some time. So it's perfect January action, may I say.
I love that. And January, you know, new year, new you, is all about taking action. So the QR code is in the middle of the screen. So just hold your phone up to it and it will take you to PensionBee where you can register. Similarly, we are giving you 24-hour priority access to the Propelle platform. We're technically still in a closed beta, but if you use the QR code, you can get access to the platform. What's in it? We have a lot of things. We have a range of investment courses where we've really broken down investing into bite-sized digestible pieces. 5 minutes, 10 minutes, you can sort of fit it around your day. One question we get asked all the time is, how do I know if I invest in something, it's even going to help me reach my goal? So we've built a tool that helps you to identify your goals, understand where you are today, and to calculate how much money you need to reach your goal. And then it will show you a range of different sort of returns that you could get to help you get there, so that you can start to understand which sorts of investments can help you reach your goal. And the piece of news that I'm always happy to shout about is that we will be launching our own ISAs and general investment accounts very soon. So to stay up to date on all that information, please do join. QR code is on the screen. And just wrapping up, our next Propelle webinar is all about ISAs. So we'll go even further than we have today. It's called Fall in Love with Your ISA, a Financial Affair, because it is February and February is going to be all about love because of Valentine's Day. So if you are interested in that, please do click the QR code. There we go. People are sending hearts, already getting into the spirit of it. So before we wrap up, I just wanted to hand over to Becky and to Alice to leave us with any sort of final words, or is there anything that you'd like to say? So Becky, do you want to go first?
Good luck. I think, don't be disheartened if you're not immediately sure on what to do. Just keep thinking about it over the next few weeks and months. And it's a marathon, not a sprint. That we've got the luxury, most of us, with a little bit of time to plan for retirement. So plenty of time to increase contributions and combine if that's what you feel is right for you to do, and to think about ISAs and what you can actually afford too, because we've not really talked about that, but budgeting is an essential part of all of this too. So baby steps.
Perfect. Alice?
Yeah, so I guess a bit of a sort of resource, or if you're still feeling confused, or you want a more I guess something tangible as to what your retirement could actually look like. There is a really useful resource by the Pensions and Lifetime Savings Association called the Retirement Living Standards. And it basically translates how much you're saving into your or investing into your pension now, and what that will mean in terms of the kind of life that you might have. And there are 3 different levels. I actually translated it into something called the Hot Girl Retirement, which you'll find on Instagram at Go Fund Yourself, and on the website, which basically turned the retirement living standards into 3 different nans or grannies, and what their kind of lifestyles look like. But yeah, I think it's a really, really useful resource, because often pensions can become very granular and all about numbers, and actually we need to remember that it's about being able to have a good quality of life when we hopefully stop working. So yeah, that would be my one takeaway.
Fantastic. And that is it. We've only gone 6 minutes over, which is, apologies for that, but we really did want to get to the end of everything and to answer as many of your questions as possible. So I think the last thing for me to do is to thank Alice and Becky for joining me this evening. It's been absolutely fantastic to have you both. Please do follow us all. Our Instagram handles are in the top left, at Propelle, at PensionBee, and at Go Fund Yourself. Thank you all so much for joining us this evening. We will be sending around details of how you can get the recording, and your questions will be answered in the Propelle community chat. So that's it from us. Have a wonderful evening, and hopefully see you at the next webinar. Thanks very much, everybody. Bye.
Thanks. Bye.
Bye.